Investing in the stock market might seem intimidating, especially to young adults who barely have a dollar to spare and are burdened by a $98,000 student loan for a degree that doesn't seem to help. Yet, when approached wisely, you can take your single dollar, turn it into two. What exactly are stocks? Stocks, also called shares, represent fractional ownership of a company. For instance, if Apple hypothetically had 100 shares and you bought one, you would own 1/100 of Apple.
Investing isn't about predicting every market move. It's about staying disciplined, informed, and patient enough to let time do its work.
In reality, companies like Apple have millions of shares. Owning stock means owning a portion of the company, and as the company's value grows, so does your investment. Stocks come in two types: common and preferred. Common stocks usually include voting rights, allowing shareholders to have a say in important company decisions such as board appointments or mergers. Preferred stocks, on the other hand, typically don't come with voting rights but give shareholders priority in receiving dividends, which are profits shared among shareholders. They also get priority in other financial matters.
Your financial freedom begins the moment you decide to learn about investing. Education is your best asset.
While stocks can become more complex, these basics provide a solid foundation for beginners. Why do companies sell stocks? Companies sell stocks primarily to raise capital. Selling shares enables businesses to gather large amounts of funds without the need for additional products or services. Today's stock market often values companies based on potential future earnings. This allows even relatively modest-sized companies to raise millions or billions of dollars if investors see potential for future success. Companies first sell stocks through an initial public offering, IPO, on a stock exchange, transforming a privately owned enterprise into a publicly traded one.
Even the most successful investors once faced doubts. Embrace the learning curve because experience is the best teacher.
An IPO provides a chance for company founders to cash out their investments or raise additional operating funds. Once listed, shares become publicly tradable, and prices fluctuate based on market perception and company performance indicators like earnings, often measured through metrics such as price-to-earnings ratios. Why stock prices fluctuate? Stock prices fluctuate due to millions of individual investors, each making their own buying or selling decisions. When more people buy a stock, its price rises. Conversely, when investors decide to sell, prices drop.
Every small investment today has the potential to be the foundation of your financial future tomorrow. Remember, it's not timing the market, but time in the market that builds lasting wealth.
Supply and demand. Supply and demand explain every stock transaction involves a buyer and a seller. If buyers outnumber sellers, prices increase. If sellers dominate, prices decrease. Investors often refer to the bid-ask spread, the difference between what buyers are willing to pay bid and sellers are asking for ask. At its core, the law of supply and demand determines a stock's price. Greater demand drives prices higher, and greater supply pushes them lower. Automated trading systems. Initially, the stock market matched buyers and sellers manually on trading floors. Nowadays, transactions occur through automated electronic trading platforms. This technology accelerates market activity, leading to the rapid price changes that are commonplace today.
Don't underestimate the power of small, consistent investments. Over time, they become your strongest financial allies.
Why should you invest? You might wonder why investing is worth your effort when banks offer around 1 to 3% annual interest. The straightforward answer: potentially higher returns. For example, If you'd invested $1,002 in Amazon in 1996, your investment would now be worth roughly $1.6 million. While this represents a long investment timeline, most investors would agree it's worthwhile. Other successful companies regularly provide returns of 31 to 69% per year, significantly outpacing bank interest rates. As long as you achieve returns higher than typical bank interest rates, investing your money offers clear advantages.
Successful investing is less about luck and more about discipline, patience, and continuous learning. Embrace risk intelligently. The biggest risk you face is choosing not to invest at all.
How to get started investing. To begin investing, first open a trading account with a service provider like E-Trade, major banks, or commission-free platforms such as Robinhood. Traditional trading platforms usually charge transaction fees, but modern options like Robinhood have eliminated fees entirely, allowing you to invest every penny. Next, decide which companies to invest in, arguably the most challenging aspect of investing. Stocks range dramatically in price, from mere pennies to several $1,000s. Importantly, stocks must be purchased as whole shares. Fractional purchases aren't typically possible, though certain platforms now offer fractional investing. Before investing, perform thorough research. Understand how the company earns revenue, assess its financial health, and consider expert opinions and forecasts. Remember, investing always involves risks. Thus, only invest money you can afford to lose or keep tied up temporarily if prices decline.
Building wealth isn't reserved for the elite. It's accessible to anyone willing to start small, stay consistent, and grow steadily.
Conclusion: this introduction has explored fundamental aspects of the stock market, its mechanics, and how to start investing. While we haven't delved deeply into technical analysis, terminology specifics, or advanced trading strategies like margin buying, this overview equips you to confidently begin your investing journey. The best way to learn and understand the stock market is by actively participating, using modest sums initially, to build your experience and confidence as an investor.
The stock market isn't a sprint, it's a marathon where steady pace and thoughtful decisions build lasting wealth. Financial success doesn't come overnight, it's built day by day with smart investments, patience, and persistent learning.